Hey there, everyone. Welcome to Chart This with Dave Keller, our Friday special all mailbag edition. I'm your host, Dave Keller. It's Friday, May 9th, and we're coming to you from a beautifully sunny Redmond, Washington. We're actually kicking off a little earlier than normal, trying a different timing for the Friday show because I usually have Friday afternoon soccer that I have to take my son to, and we're getting a little pinch timing-wise, and I'm seeing if this helps make the Keller family work a little more smoothly here on a Friday evening. We'll see how this goes, but I appreciate you courageously tuning in 30 minutes earlier than I normally kick off on Friday, and hope you guys are all doing well. Kind of a choppy, sloppy, sideways event, less than eventful Friday session with the S&P and the NASDAQ essentially chopping around, ending the day unchanged after a quite noisy week. We'll briefly look at the charts here, and particularly the chart of the S&P 500. And then I've got to, 5 great questions that we received this week. As a reminder, this show is a ton of fun because of the interactive nature of it. I love seeing the comments and questions as we go. We get so many great questions. We rarely make enough time for it during the regular week. So Friday's episode, we like to spend a little more time thoughtfully and maybe a little more intentionally answering some of the great questions we've received. So my point of saying all that is please keep the great questions coming. You can enter them into the chat during the live broadcast. Any of the platforms upon which we're streaming, just put a comment on that platform. I can see that all real time on my side. And also, if you're watching the replays on our YouTube channel, just put a comment below the video with your question. We'll gather all of those, we put in the mailbag, and then hand select some great ones to discuss on a Friday episode. Donald mentioning on YouTube, nice to have some less volatile days, right? This is the reality of the VIX being so elevated, by the way, is that a day like this is remarkably rare, right? The average day has big percentage swings when down the road, we're in a nice low volatility, very boring uptrend. Remember how this felt. And when someone asks, what is it like when the VIX is up above 20, up above 30, tell them feels kind of like this, big swings day to day, hard to get a read on what's going on. Man, that's where we're at. All right, let's do a quick market recap. We'll just check in on how things played out. We'll look at the chart of the S&P, and then we'll get to some really good questions here. So looking at the major averages, again, kind of a quiet day, compared to the last couple of weeks. This was a sort of a light movement sort of day. I'll take it. Great way to finish the week. We came down a bit over the last 2 sessions, really from midday yesterday when the S&P was around 5720. We're closing the week around 5660. That's still very close within shouting distance of the 200-day moving average. So I think going into next week, that remains the main question. Does 5750 hold on the upside as it did in late April? So the S&P at 5660, we'll call it. That's essentially flat for the day. The NASDAQ composite, again, almost dead even from Thursday's close. Mid caps, small caps, S&P 100, NASDAQ 100 were less than 0.1% away, so not much. The VIX did move slightly lower here today. Ended at the lows, toward the lows of the week. We're just below 22 on the VIX. So we're very close to the VIX getting actually back below 20, which would be a low volatility environment, which could arguably be pretty nice change of pace here, given all the volatility we've experienced. Interest rates, also not a huge change. The market recap portion may be quick here. Dollar, the 10-year yield, Treasury bonds essentially ended the day where they started. Biggest movements were in the commodity space. You'll see in a moment the energy sector was the top performer. Crude oil prices higher, natural gas prices higher, gold, silver, precious metals, kind of everything in the commodity complex moving to the upside. Bitcoin has been on a rage of an upswing over the last 48 hours. Yesterday, we saw Bitcoin get up to around 103,000 earlier in the day today, kind of overnight Eastern time. Bitcoin briefly pushed above 104,000, currently trading just about 103,240, we'll call it. Basically flat for the day, but keep an eye on Ethereum, which has aggressively been moving higher. I mean, huge upswing yesterday, up another 6% today. We're at 2335. So one of the impressions we had going into a Trump administration was obviously kind of a pro-cryptocurrency, platform among many things he talked about. That was one, and certainly that this seems to be following through, as you might expect, given the optimism going into his administration related to crypto. All right, looking at the 11 S&P sectors, so kind of generally more positive, but not by much. A couple of the sectors were basically flat for the day. You had a couple up, a couple down. Energy up 1%. REITs, number 2, up 0.6%. Consumer discretionary up 0.5%. The rest were up sort of a de minimis amount. On the downside, 4 of the S&P sectors to the down on the downside. Healthcare, number 1, down 1.1%. Healthcare continues to be one of those sectors we're generally underweighting in our work. Just not a great relative bet, and really struggling to find its footing here as it underperforms. Consumer staples, second from the bottom. Communication services, third from the bottom, both down about 0.5% from yesterday's close. Doesn't look like there'll be any change in our market trend model. We'll dig into the data a little bit more as we prepare for our weekly flight plan with our market misbehavior premium members over the weekend. That's our primary report. But for now, looks to be pretty stable. Breadth was actually kind of mixed today. You can see, on the New York Composite Index, which is probably the most important one, 55% of stocks up, 43% of stocks down. So there was kind of a gentle upward bias to the breadth data. On the S&P, it was almost a 50-50 split. On the Mag 7 names, note that Tesla having a really good update. Tesla's actually, following through here and making a new 3-month high today. I'll look at that chart here in a moment. You can see the returns in the rest of the Magnificent 7. This is probably the one that I would highlight because it's not quite a 3-month high. That's not true. 3-month high would be back up here, but we did break above the 200-day moving average. Tesla has failed numerous times in March and April to get above the 200-day moving average. Today, we close above it. Question for Monday, do we follow through? Anytime you have a breakout of key resistance, do you see follow through to the upside? And that's the question for Tesla. But for now, initial breakout, pretty encouraging. Market carpet is here. You can see Tesla up there. You can see in the technology space, if you missed it, CrowdStrike, that is, down about 4+% today. Pulling back after attempting to make a new high above that February peak at 450. When I reflect on what happened this week, and again, I usually do that over the weekend when I've got some time and space to take some deep breaths and review what happened. Charts like CrowdStrike are discouraging and certainly bring into question the sustainability of the uptrend, right? I mean, you want charts like that to not trade to resistance, but through resistance. For now, CrowdStrike is stalling out at that previous peak. Chart of the S&P 500. Basically, we had an inside day today. So yesterday, a pretty wide range. Today, lower high, higher low. Bar chart methodology would tell you that's an inside day, which is basically lower volatility. So we had a doji candle on Thursday. We've got this bearish inside day today. It's not it's not a resounding bullish way to end the week. I mean, there are worse things that could have happened for sure. I mean, the S&P generally treading water. I mean, if you look at last Friday's bar, that's this one here. And then you have these 5 days where literally this Friday and last Friday were almost an identical trading range. So we really have kind of stalled out here. And I'm not super surprised because we've had a pretty aggressive run from the early April low up to an early May, where we're at right now. A lot of people questioning whether we can sustain a move above the 200-day moving average. The market's telling you wait and see mode. No clear direction just yet. All right, let's get to some of the thoughtful questions we received. As a reminder, I can get questions all during the live streams and also in our YouTube channel. Just put a comment below the video you're watching with your questions. We'll get to as many as we can. Anything we don't get to, we'll pop it into the mailbag and hopefully answer it on our next mailbag episode. Question 1, can you explain the Elder Impulse system? What would be good complementary indicators? RSI, ADX, or directional movement, shaken money flow for volume? Question. So first off, congrats on spelling complementary correct with an E and not an I. Complementary would be like, hey, nice indicators. Complementary in this form is what complements, what partners with the Elder Impulse system a little bit better. So I did set up this chart just to give you a quick demo of the Elder Impulse system if you're not familiar with it. This comes from one of Dr. Alexander Elder's books called Come Into My Trading Room. He's had a couple books that are just really interesting about just trading for a living or the new trading for a living. Come Into My Trading Room. Just great kind of books about just the act of trading, making it a career, how to your livelihood thinking about risk versus reward, thinking about timeframes, a lot of just like basic trading principles that you want to kind of get right or you want to learn about. Great starting point. Someone suggested getting him on the podcast. On my list, I'll see what I can do. I have, interviewed Dr. Elder before and have spoken to him, but it's been a little while, so I'll see if I can rekindle that one and see what I can do for all of us. So the Elder Impulse System, and you mentioned you had a longer question in there. It basically does use two things. It uses an exponential moving average and uses the MACD indicator as a way of overlaying on the price bars themselves the trading conditions of the current setup. So the Elder Impulse System on stock charts, the way you set it up is you have to change your chart type. So open, high, low, close bars are what I usually do. But if you click there and change it to Elder Impulse System, it's basically thick price bars with a color coding, and that's what the indicator is. What I love about it, and I'll get to the mechanics of it in a minute, what I love about it is this is one of those things that doesn't take up extra space, right? So with technical indicators, the more indicators you add, the more you're kind of compressing the data or adding a lot of noise. What this system does, it actually uses colors to, describe different conditions that are in play. And the short version is green bars mean we're in an upswing. Red bars mean we're in a downswing. Blue bars mean it's neutral. And it's just at any point, a chart is in one of those three phases. Now, the way that it does it, the way you can see it very easily, add a 13-day exponential moving average. I have that. That's the line here. And then I added the MACD indicator with its traditional settings. And you want to ignore the MACD lines and just look at the histogram. And we can actually just do that, which will take away the lines. And now we're just looking at the histogram built off of that MACD indicator. So the lines are green if the 13-day exponential moving average is trending higher and the MACD histogram is increasing. The bars are red if the 13-day EMA is sloping downwards and the histogram is also going down. And if only one of those things is in play at any point, then it's blue, right? If they're not both going up or both going down, if one's up and one's down, then it's blue, and that just means neutral. So this is by design kind of a short-term swing trading kind of thing. The general idea is when the bars go from green to blue to red, that's kind of your short position. When the bars go from red to blue to green, that's kind of your long trade. He has a whole bunch of things which he talks about in the book about ways to sort of think about this. One of the other things that he talks about is thinking of a 5 times these periods as being more of a long-term gauge. You could either make this a 65-day EMA or just run this on a weekly time period, and it'll give you kind of the weekly version. So the idea is think about the longer-term trend and then think about how these swings fit into the short term. You asked in your question, do I ever use this? The answer is no, I really don't. Only because I'm not a swing trader as much. It's kind of not my primary area of focus. If I was really trying to capture some of these shorter term swings, I would use the Elder Impulse System for sure. I would use it along with like a 9-bar or even a 5-bar RSI to measure kind of overbought, oversold conditions and look at these swings. The good news is once you understand how the indicator works, you don't have to use the MACD and you don't have to use the exponential moving average. This indicator kind of combines all of them. And that's the beauty of it. You can use it with other things like RSI or what you had mentioned, and this is kind of getting to the final part of your question. If I'm like a swing trader kind of time frame, I'm probably looking at something like this. Again, I haven't spent a lot of time optimizing this toolkit. This is probably similar to what I would start with, looking at the Elder Impulse bars as a way of just making sure I'm not fighting those trends, using the RSI as a way of just anticipating when a reversal might happen, looking for divergences and things like that. That would be sort of an interesting way to do it. So that's how I would kind of think about it. Again, I don't personally use it because it's a little shorter of a time frame than I'm normally trading. But again, if you're more in that swing trading, like couple days to a couple weeks kind of time frame, this could be really helpful. And if you're struggling on that short-term tactical time frame, feel like you're missing things, maybe this is an interesting addition to your charts to sort of complement it. What I would say is you don't need to use something like MACD with this because it's already built into the impulse system. So this kind of combines moving averages and MACD. I would use indicators with other inputs and background as a way to do it. There's an article, a really good article on the Stock Charts website. It's a free article that talks about the Elder Impulse system. I'll try to remember to put a link in the description below, which I'm writing down now. And you're welcome to read, check out that article. Just go to the Stock Charts and search for Elder Impulse System. And yes, Chuck, I am live today, which I normally don't do. I usually record this a little earlier, but that's how things played out, so I'm going with it. All right, question number 2. I keep hearing that timing the market is a no-no. Missed the 9 up days over the last 20 years, and our portfolio growth suffers significantly. Thoughts? Yeah, I mean, I think there's so many different, again, I think I appreciate your question very much. I think a lot of people approach investing, really thinking there's that one thing, that holy grail kind of approach. And if you can just find that one thing, then it's going to be easy and you just kind of follow it, right? So if I can just find that indicator that gets me in the markets when I should be, and then gets me out of the markets when I shouldn't be, it'd be very easy. I interviewed Yuri and Timur of Fidelity, which is top of my mind. We don't have the episode ready. Hopefully soon. My editor has that working on it right now. But we talked a lot about just how to think about things on different time frames. And the reality is some investors have a much longer term time frame. So they're really not trying to time things in or out. I would say for most human beings, right, for most people that have some sort of portfolio, some sort of nest egg, you're not going to want to spend the time and effort that I think is necessary to manage those investments actively and have consistent success. You're going to have sporadic success and also sporadic disasters probably in that scenario. So there's a subset of people that, want to manage things more actively and want to work to outperform a passive benchmark, but also have the time and dedication and effort available to be able to do that. Hopefully you're all watching my show, and that's the community that we're building, are people that are trying to do so and really want to improve their capabilities for that. It's kind of what I'm trying to help people do. So having said that, I think that's one of the arguments that people make against timing the market, against managing money actively. And they will cite evidence like, well, if you miss the last, the best 10 days, your returns go blah, blah, blah. I mean, that's one of those things, to be totally honest with you. That's one of those things where I think you can make the evidence look any way you want, right? What about if you avoid the worst days? Your returns get a lot better. And so, there's this whole argument that justifies not managing things actively. But the financial industry and history is full of people that have been able to, outperform over long periods of time. Warren Buffett, probably one of those great examples, with a very long-term time frame and very low turnover. But he found something that works, and he did it consistently for many, many years, and able to grow the portfolio very, very nicely. I've worked with money managers that have been able to outperform pretty consistently. Some of them, focus on timing and focus on, being in and out of things when it makes sense to do so. We often highlight investors, active investors. The whole active to passive debate, is often, dominated by examples where people did not, actively manage but didn't perform well. That's often cited as a failure of active management. I would say that argues that a lot more active managers need to use charts and technical analysis. A lot of them don't. And I don't know if there's a direct correlation between how closely you follow the charts and how well you manage risk. But, the big problem a lot of active managers have is being in the wrong place and just holding on to the wrong trades and just not recognizing that the market has shifted. And so that's what we try to focus on as much as possible. So I would disagree with that general assessment of that, that timing the market is a no-no. I think doing it without a pretty good process is probably not a great idea. And that's why I would say in my own portfolio, I actively manage parts of it. Parts of it are technically active managed, but it's more of a momentum-based systematic portfolio that I really try desperately not to disagree with the model. I just follow it. And that balance for me makes a lot of sense. It's a good mix of kind of, smart beta, I guess you would call it, and then, active idea generation. That's what works for me. Next question, is Spotify putting on a potential 3 black crows candlestick pattern? Love it. We're going candlesticks today. Let's go for it. Spotify. So three, oh, I did look at this question earlier, and I grabbed another chart, VMD, which I thought had a pretty good example. So you're asking about this right here. Is this a potential three black crows pattern? So the answer is maybe, right? At this point, it's too early to say a three black crows pattern. If you know your candle charts, basically we're going up, and then you have these three long down days, and the adjective long is part of it. There's not a specific, I think, requirement of how big they have to be because that's a little more subjective. But the idea is compared to the normal volatility, you're going up and then you have three big distribution days. If I remember right, the open of each day needs to open within the previous day's trading range. So no gaps or anything, which would mean it might be something else. But it's basically three big down candles. VMD, Viomed Healthcare. I actually use the stock charts platform, which has a built-in screen, a scan for stocks doing a three black crows pattern. There aren't many right now, but this is one US stock that was flagged. And so this is kind of what the pattern looks like. This is a big exaggerated pattern because yesterday was a huge sell-off, I think, due to earnings. But I look back to the left and I found this. This is a pretty good example, I would say, of a three black crows pattern, right? So you rally higher, you have kind of this throwaway candle, and then you have one, two, and boy, it's probably not because we didn't open within the previous ones. This is close. So that's the idea. That's what more what it looks like. So is this a, three black crows? I mean, it might be. I wouldn't include that as one of them. That's not a crow because the idea is it's a big distribution. So you open, you trade down a lot and close toward the lows. If the open and the close are kind of together like that, that's more like a hanging man kind of candle, a little different. So this could be bar one, which means you'd need two more bars, and I would caution you against declaring a pattern like that being confirmed until you have the three down days. That's how the candle patterns work. You really can't guess what's going to happen next because if tomorrow, if Monday opens and rips higher, all of a sudden it's obviously not a three black crows, and you move on from it. If you want to follow along with that, by the way, and look for new examples next week on stock charts, click on charts and tools, and then there's a thing called predefined scans, and then scoot your way down here. Candlestick patterns, bullish ones, bearish ones, three black crows. Again, not many, and this is going to update during the day as charts reveal themselves. The opposite, which would be three up candles after a drawdown, is called three white soldiers. And you can, again, it's not very common because it's pretty uncommon to see that pattern, but when it does, that's when you want to tend to abide by it. So that's how you can find it. That's what the pattern is and how it works. All right, we'll continue on in a minute. I do want to remind all of you, the Seeking Alpha folks have a spring sale going through Mother's Day. And friendly reminder, Mother's Day is Sunday, so I hope you've taken care of that. Sons and daughters watching, if not, I hope you can do so very soon so your moms are all happy. But Seeking Alpha Premium is something they're offering in the beginning of May. The offers open through the end of Sunday evening. If you can use my link, marketmisbehavior.com/Seeking Alpha, you can get $30 off Seeking Alpha Premium, which is their premium membership, which includes access to their quantitative model, a lot of really cool features, research, data, etc. And they're also throwing in their next Alpha Pick, which is where they hand select one of those highly rated names from their quant model and dig into it a little bit deeper. So they'll include the next one for free. You can get more information at marketmisbehavior.com/Seeking Alpha. If you use that link, it gives you a little better deal than others and helps me make a Market Misbehavior awesome. Let's continue on. Two more questions, and then we'll call it a weekend. Dave, what's your take on the recent distribution moves at the end of the day? Are these signs that smart money is de-risking while retail investors continue to buy the dips? It's a really good question, and I will tell you that I can tell you what I think it might represent. It's really hard to generalize too much, and I will tell you what you have to remember when you're looking at something like this and looking at the last half hour of trading or last hour of trading or the first 30 minutes of trading. It's similar to what happens when you see a price move and you see big volume. You're making a bunch of assumptions as to what that volume might represent. Right. So generally, the last hour of trading is where big institutions tend to move a lot of their volume. And the reason is because if you're looking to sell a bunch of stuff, if you go doing it right, here, everyone sees a big player is starting to liquidate. As a result, they all try to get ahead of it. they all start to sell, and all of a sudden it's not helping you get a good fill, which is not helping your client or whoever's money that you're managing at that particular time. So a big part of what buy-side traders and their purpose in life, to be honest with you, in a lot of ways, is to make sure that they, move the volume that they need, but in a way that does not disrupt the market. And actually, tools on Bloomberg, if you've never worked in an institutional trading kind of environment, like a buy-side trading desk, there are functions, there are tools on platforms like Bloomberg, like institutional market data platforms that actually let you calculate, I don't want to be more than 5% of the day's volume on a stock, and looking at VWAP and making sure that you're generally filled above the VWAP on sells or below the VWAP for buys, and looking at indications of interest and all these different things to help you try to optimize that challenge that you have, which is getting a bunch of, stocks out of the firm or accumulating a bunch without telegraphing to all the other market participants what you're doing, which usually means other people try to get ahead of you, which just means you get worse fills, you get worse price action. And as a result, it hurts your returns and it hurts your shareholders. So you reserve the big volume to the end of the day. And so the last hour, it's dominated by institutions, and it's dominated by, ETFs, like where they have to rebalance it. They have to buy or sell shares. That usually happens at the end of the day as well. And you can kind of see it. Like if you do like one day, and if we do the volume, you'll see that like there's always a ton of volume, like right out of the open. And then there's a ton of volume right at the end of the day. And you can see it kind of builds up in the last hour. The middle of the day is kind of this lighter volume, kind of snooze type of period. And even on a 5-day chart, you see that's a normal kind of U shape to the volume where there's a bunch right out of the open, which is often a lot more retail investors. There's a bunch going into the close. And that's a lot of, institutional volume tries to save it to the end. Because again, once people see what's happening, they all kind of try to front run it as much as possible. So that was a long-winded answer. Sorry for that, of saying, what does this mean? So I can tell you what it might mean. And again, it's making an assumption. The real answer would be, somehow have inside data from a bunch of firms and what they're doing, which we obviously cannot do. So we have to make some inferences or some assumptions about what that means. And so the direction going into the close with all this volume is probably institutions unwinding some sort of position. So, when I'm looking at the last 5 days or the 5 days of last week, I see Monday with big distribution in the last hour. I see Thursday with big distribution in the last hour. Today, kind of big distribution, Tuesday, kind of distribution. Wednesday was Fed day, which is kind of a weird outlier anyways. So 4 out of the 5 days, except for Fed day, the market sold off in the last 20 minutes, and in many cases sold off in the last half hour. I can't see that as a good thing. That usually means there's profit taking, there's people unwinding positions as a result. But again, we would never make long-term decisions based on that. That's more anecdotal evidence. And I would bucket that similar to what you think of like the AAII survey, their name exposure index. Gives you an idea of supply and demand and what institutions are doing. At the end of the day, price is what's most important. That's why our toolkit is based not as much on inference, but more on analyzing price action itself. What are the trends? What are the moving averages? What are the price patterns telling us about the interplay between supply and demand, between fear and greed? Final question, then we'll call it a weekend. Based on the daily chart, Dell seems to be coming out of the woods, but I'm not sure that the weekly chart supports that view. What do you think? As always, not making a recommendation of any sorts, but let's take a look. So here's the daily chart of Dell. We'll start here. It appears to be coming out of the woods, and I would agree. I mean, Dell looks like a lot of other names that have had a really important V bottom, selling off into early April, accelerating out of those lows through mid-April, now into early May. The question for Dell and all the Dells of the world is, did they get above that March high? And I haven't done this analysis, but one thing that I'm wondering is how many stocks like this have broken above their March peak and how many are below it. Dell right now has an even worse problem because $100 a share is right at that level, kind of a big round number. And so getting above that level, I mean, setting an alert for Dell, which I'm writing down right now, Dell over 100, waiting for that kind of breakout for me kind of makes sense. So You know, if you for some reason bought here, that's great. I would be holding it to see if we get follow through. If not, I'm probably waiting to validate this upswing with a break above that $100 level. But certainly a nice rally for sure. And a lot of these, I would say, with a lot of these, they felt like they've almost gone straight up, some sort of pullback, you know, over like a week or two to just give you a clear sense that on sell-offs, people are buying on the dips. This still feels pretty irrational to rally off the April low. Something like that to further validate the accumulation phase, I think could be really interesting. Weekly chart of Dell going back further. And if you're wondering why Dell only starts in 2018, right? So Dell's been around for a while, but the chart only starts here. If you remember right, Dell was a public company till like here somewhere, like 2012 or 13, if I remember right. Then it went back private and then had a re-release in late 2018. So that's why there's kind of a gap in the, or there's just not a lot of data for Dell. It was basically another, like a second IPO in late 18. It had gone private early in the 2010s and then kind of came back here. So we've got data from late 2018 to where we're at. So the weekly chart's actually pretty interesting, I would say. We are you know, over the last month, that April low closed below the 150-week moving average and then bounced back above that. That's kind of my favorite long-term average to use on the weekly charts. I love using that as a general framework to watch. I'm looking at the weekly chart of Dell. I'm seeing three major lows, one at the COVID low, one in late 2022, and then maybe this one that we've just experienced. And if you look at the weekly PPO, you can see a buy signal soon after that low in April of 2020. You can see a buy signal here in late October of 2022. We're not quite at a buy signal, but boy, really close to doing that. I think that would be the thing that I would be watching here. Anytime we have a sell-off like this, and the reason why I've not been really bulled up on some of these charts yet is because with my methodology, which is more trend following, I see this as like a big drop and a big spike. And now we're kind of back within the general trend that's been in play. So if we draw a trend line from this peak to this peak, we're still kind of below that. And the weekly PPO for me is often a great indicator to finally encourage me to say, you know what, that bottom is probably in, and it's worth taking a shot that, you know, you limit your risk down to those previous lows, you take your upswing from there and kind of take it from there. That's why I would think of the chart of Dell. Again, a lot of these charts, I think they'd rally beautifully in the month of April into early May. Now the question is the sustainability of those gains on the daily chart. I think Dell over 100 is a nice validation of the uptrend phase on Dell. I think the weekly chart, I think a PPO buy signal, if you look back in history, has been a pretty good sign that that new rally phase is probably in place. Wouldn't take much to get that signal happening. When that happens, I think it's reasonable to be pretty bullish on a chart like that. Folks, that'll do it. A couple questions we got during the live show today. I'm going to throw those in the mailbag, and we'll try to get to them next week. In the meantime, I hope you guys have a fantastic weekend. We are doing a number of things. We got soccer going. I don't know what else we're doing. Mother's Day on Sunday, and Mrs. Keller, my wife, wants to get the garden back going. We've got some wild strawberries. We've got blueberry bushes growing here in Redmond, Washington. We've also got 6 raised beds. We'll see what we can, what sort of action we could get into those, but we'll be digging into the dirt. Hope you guys enjoy the weekend, and happy Mother's Day to all of you who celebrate. And remember, it's always a good day to own good charts. Take care, folks. Bye now.